Decoding the term sheet, your roadmap to funding. Securing venture capital is a significant milestone for any startup, but the process involves navigating complex legal documents, with the term sheet being the most crucial. This document outlines the proposed investment terms and serves as the foundation for the final agreement. It's not just about the money, it's about protecting your company's vision and your stake in its success. Each clause, from valuation to liquidation preferences, has long-term implications for your business. Start by understanding the basic structure of a term sheet. Familiarize yourself with standard industry terms and seek clarification on any jargon or ambiguous language. Remember, the term sheet is a starting point for negotiation. Draft versus final, navigating the stages of agreement. The journey from initial discussions to a signed investment agreement typically involves multiple drafts of the term sheet. A draft term sheet is a preliminary document outlining the proposed investment terms. It serves as a basis for negotiation and is subject to change as both parties discuss and refine the terms. The final term sheet, once both parties agree on all terms, becomes a binding agreement. It forms the basis for drafting the definitive legal documents, such as the stock purchase agreement and shareholder agreement. Once signed, both parties are legally obligated to honor the terms. It's crucial to note that even a draft term sheet can include binding provisions. For example, clauses related to exclusivity or confidentiality are often binding from the draft stage. Always clarify which provisions are binding in the draft stage to avoid surprises later. The power of avoiding risky deal structures. In the excitement of securing funding, it's easy to overlook red flags in deal structures. Certain deal terms, while seemingly attractive on the surface, can put your company at risk. One such red flag is accepting cryptocurrency as payment for equity. The volatility of cryptocurrency markets can create significant financial instability for your company. Another risky proposition is agreeing to upfront payments to funders outside the agreed-upon investment structure. Be wary of deals that heavily favor the investor at the expense of the company and its founders. Trust your instincts, seek advice from experienced entrepreneurs or mentors, and be prepared to say no to terms that don't align with your long-term vision. It's better to walk away from a deal that doesn't feel right than to enter into an agreement that could jeopardize your company's future. Debt, convertible debt, and hybrids. Choosing the right path. Venture capital financing doesn't always equate to giving away equity. Different deal structures exist, each with its own implications for your company's ownership, control, and future fundraising. Debt financing involves borrowing money from investors that you repay with interest over a set period. Convertible debt offers a hybrid approach, starting as debt but converting to equity in the future. Hybrid deals combine elements of both debt and equity financing. They might involve issuing preferred stock with debt-like features, such as guaranteed dividends or priority in liquidation. The best deal structure depends on factors like your company's stage, risk appetite, future funding plans, and the investor's preferences. Carefully evaluate the pros and cons of each option with your team and legal advisors. Make an informed decision that aligns with your company's long-term goals. Mastering the art of negotiation, interest rates, and beyond. Negotiating a term sheet is an intricate dance. Interest rates are a key point of negotiation in debt and convertible debt deals. Aim for competitive rates that minimize your financial burden without hindering growth. Prepayment options are another crucial aspect to consider. The ability to prepay your debt without penalty provides financial flexibility. Debt service terms, including the frequency and amount of payments, also warrant careful consideration. In convertible debt deals, focus on negotiating favorable equity conversion provisions. Thoroughly research industry benchmarks, understand your company's financial position, and be prepared to justify your proposed terms. Your ability to negotiate effectively can significantly impact your company's future. Liquidation preferences. Understanding your stake in success. Liquidation preferences dictate how proceeds are distributed among shareholders in the event of a company's acquisition, merger, or liquidation. Typically, investors negotiate for a liquidation preference, ensuring they recoup their investment before common shareholders receive any returns. A common type is the one-times liquidation preference, where investors receive their initial investment back before any other shareholder. A higher multiple, like 2 times or 3 times, allows investors to receive multiples of their original investment before other shareholders receive anything. Participating liquidation preferences provide investors with an even greater upside. Negotiating favorable liquidation preferences is crucial for founders. Aim for lower multiples and, if possible, push for non-participating preferences. This ensures a fairer distribution of proceeds and protects the upside potential for founders and early employees. Anti-dilution provisions, protecting your equity share. Anti-dilution provisions protect investors from having their ownership stake diluted in future funding rounds if the company raises capital at a lower valuation than in the current round. These provisions work by adjusting the conversion price of the preferred stock issued in the current round. There are 2 main types of anti-dilution provisions: full ratchet and weighted average. Full ratchet anti-dilution resets the conversion price to the price of the new, lower-priced shares, effectively giving investors more shares. Weighted average anti-dilution considers the size of both the current and subsequent funding rounds when adjusting the conversion price. This approach results in a smaller adjustment and less dilution for existing shareholders. Negotiating for a weighted average anti-dilution provision is generally more favorable for founders. It provides a balance between protecting investors from down rounds and minimizing the impact on existing shareholders. Understanding these nuances is crucial for founders. Veto rights and founder control balancing power dynamics. Veto rights grant investors the power to block certain company decisions. Common areas where investors may seek veto rights include future financing rounds, sale or acquisition of the company, and major strategic partnerships. Granting too many veto rights can shift the balance of power away from the founders. Negotiate veto rights carefully and limit them to major decisions that materially impact the investor's investment. Clearly define the scope of each veto right to ensure it aligns with the company's long-term vision. Vesting schedules and founder commitments. Aligning incentives. Vesting schedules determine the time frame over which founders and key employees earn their equity. This mechanism protects investors by ensuring that founders stay committed to the company's success over the long term. A common vesting schedule is a 4-year vest with a 1-year cliff. Founder commitments outline the expected contributions of founders to the company's growth. These commitments can include full-time employment, specific performance milestones, or non-compete agreements. While founder commitments are common, it's crucial to ensure they are reasonable and achievable. Avoid overly restrictive terms that could limit your flexibility. Understanding these concepts is crucial for both parties to ensure long-term commitment and fair compensation. The power of legal counsel. Don't go it alone. Navigating the complexities of term sheets and investment agreements requires a deep understanding of legal and financial intricacies. An experienced lawyer specializing in venture capital financing can provide invaluable guidance throughout the process. They can help you understand the implications of each clause in the term sheet and negotiate favorable terms that protect your interests. Don't underestimate the value of experience in these matters. View legal counsel not as an expense but as an investment in your company's future. Walking away with confidence, knowing your worth. Negotiating term sheets can be an emotionally charged experience. However, it's crucial to remember that you have the power to walk away from a deal that doesn't serve your company's best interests. Walking away doesn't mean giving up. It means recognizing your worth and refusing to settle for terms that compromise your vision. Before entering any negotiation, establish clear non-negotiables, terms or conditions you are unwilling to compromise on. This clarity will empower you to walk away if those lines are crossed. Remember, securing funding is a significant milestone, but it's not the only measure of success. Trust your instincts, rely on the advice of your team and advisors, and never be afraid to walk away from a deal that doesn't feel right. Your company's future is worth fighting for.